Namaste. Good morning. We start today with filing of returns. Okay. What are all the sections to remember from the examination perspective? Okay. In filing of returns. The sections to remember include, okay, 139.1, 139.3, 139.4, 139.5. Okay, these are all the primarily we need to remember these sections. Okay, and then we'll go for the secondary list. What is 139.1? Mandatory filing of returns. That is, you have to file your returns. Okay, there is no option for anybody else other than individuals and HUF. Firm, company, LLPs, trust, all other entities, mandatory filing irrespective of operations. If they have incorporated, they have to file. They need not have operated during the last year. Okay, the law uses the phrase, if incorporated and not wound up, they have to file. If incorporated and not wound up, they have to file. So they don't have an option, technically speaking, whether to file or not. Only individuals HUF, because that is our syllabus area, also has this option. Okay, who has to file? Remember, if their gross total income exceeds basic exemption limit, they have to file their returns. If the gross total income of the individual is more than the basic exemption limit, it is not total income, it is gross total income. Law uses the word total income before providing for exemption under deduction under chapter 6A. So yes, if you have a total income exceeding basic exemption limit, you need to file your returns. Apart from that, if you are claiming 10 AA, 35 AD, okay, and 54 exemptions, that is capital gains exemption. If you are claiming 10 AA, that is export profits, 35 AD, that is specified business, or any exemptions under section 54 of the capital gains, you need to file your, even in that case, suppose my income is only capital gains, I had a capital gain of before exemption some 40 lakhs, and I have invested in a new house property 40 lakhs, I need to file my returns. Even though my return is nil, income is nil, I need to file my returns. These are all mandatorily in the case of an individuals and HUF. Okay, and then comes the special conditions. Then comes the special conditions. Okay, foreign tour, the foreign bank account. Foreign bank account, I need to, okay, file. Foreign assets, I need to file. Foreign assets, if I am holding, I need to file my return. Foreign tour expenses, exceeding 2 lakhs. EB bill, electricity bill exceeding 1 lakh. Electricity bill exceeding 1 lakh. Electricity bill exceeding 1 lakh, I need to file my return. Okay. Deposit in a savings bank account 50 lakhs plus. Okay. Current account 1 crore plus. Okay. Current account 1 crore plus. In all these cases, I need to mandatorily file my returns. That is, irrespective of the income level, I need to file my return. Am I clear to you? Am I clear to you? So mandatory filing of return, this is the questionable area here. This is the questionable area. Whether it can also be MCQ, it can also be general. That is the questionable area.
So the special case, what is the first one?
Foreign bank account. Okay, if you are a signatory to a foreign bank account, you have to file your return. Am I clear? Okay, now comes the second, 139 subsection 3. That is return of loss. That is nothing but return of loss. That section is read along with, okay, section 80. This section is read along with section 80. What is this section saying? If you have loss in these three heads, unless you file your return of income within the due date, you cannot carry forward such loss. This section just says that if you have loss under business or profession, capital gains, owning and maintenance of racehorse. Once more, if you have loss under the head business or profession, capital gains, owning and maintenance of racehorse, unless a return is filed in accordance with 139(1), you cannot carry forward such losses. Unless a return is filed with in accordance with 139(1), you cannot carry forward such losses. You cannot carry forward and set off such losses. Okay. Two losses which are not spoken about in that section are house property loss and unabsorbed depreciation. Those two can be carried forward even if you file your returns late. And only carry forward benefit is lost. Set off you can do. Current year. Set off means current year. I have a IFOS of 5 lakhs, business loss of 3 lakhs. I am filing my return after the due date. I can set off. Business loss can be set off against any head other than salaries. So I can set off. Suppose I had a business loss of 6 lakhs. I can set off 5 lakhs. That 1 lakh is lost. That 1 lakh I cannot carry forward because I'm filing my returns late. Are we clear? Okay. So read along with 80. Okay. Loss under PGBP. When I say loss under PGBP, I mean all the three losses: specified business loss, speculation business loss, and general business loss. Okay, loss under PGBP, capital losses, loss from owning and maintenance of racehorse. All these three things, okay, carry forward possible only if return of income is filed within due date. Only if return of income is filed within due date. Otherwise, you cannot carry forward these losses. Am I clear to you? Only carry forward benefit is lost. Set off you can still make. Only carry forward benefit is lost. Set off you can still make. Okay. 139(4) talks about belated return. Okay, return filed after due date. Okay, belated return means return filed after due date is known as a belated return. Once more, Belated return means return filed after the due date. Within what date you should have filed? Before 31st December. Before 31st. Due dates are 31st July, 31st October, and transfer pricing cases 30th November. 31st July, 31st October is for mandatory audit assessees. In all other cases, 31st July. So, return filed after due date. Okay, last date 31/12, okay, of the assessment year. 31/12 of the assessment year. For the financial year ending 23-24, 31/12/24. That's why if you look at now all auditor office, because it is another 10 days only available for filing all the last returns, belated returns. Same is the time limit for revised return. Okay, revised return, that is any error or omission in the return filed, be it under 139.1 or 139.4. I am repeating, the return might be a mandatory filing return or a belated return. Both can be revised, but the time limit is the same, up to 31/12 of the assessment year. Only you can revise. Am I clear to you? Am I clear to you? So remember, these are areas where, okay, they can small level test. Okay, these are areas in a small level, they can test on these areas. Okay.
So if SSC is filing a return under 131.1 and he's willing to file a revised return under 139.5, he can change the regime. Can he change the regime from old to this? Like that conversion is possible.
The conversion is possible at the time of filing the return,
and not
at the time of revising the return.
Once he filed in old tax regime in 139.1, he can't.
He can revise under the old tax regime. Am I clear, friends? Am I clear? Okay, right. Okay. Amongst the return filing section, one more section gets importance is section 139 subsection 8, updated return. Okay, updated return. That is, it is also a sort of revised return, but it can only be benefiting the department, not the assessee. It can only be benefiting the department, not the assessee. What happens? Today, information is available everywhere for the department. The department comes to know some interest which the assessee has received has not been reported. Some securities transaction, that is the capital gains that has been made. The mutual fund or the broker files something known as annual return to the income tax department. In that they will specify the name. Okay, so and so has transacted so and so of money. So they can now, income tax department will verify in the assessee's return of income whether that has been disclosed properly by the assessee. Where the assessee has not disclosed it properly, department can open the case. Okay, so instead what the assessee says, that portal is always transparently visible. That is, AO can also, assessing officer can also view that, assessee can also view that. So in the portal, the assessee sees that, look, my income as which I have missed in my return of income is there in the portal. Now they will send the notice. Instead, I myself will voluntarily offer that amount as my income. Okay, so this is a situation by filing updated return. Okay, updated return. Remember some things. Time limit. Okay, 2 years from the end of the assessment year. Updated return can be filed within, should be filed, maximum period is 2 years from the end of the assessment year. So if my financial year is 23-24, assessment year is 24-25, 2 years from that date, from 31-3-25, I get 2 years. Before 31-3-27, I should have filed. I should have filed my updated return. This is the time limit. Okay, right? Who cannot file updated return? That is what is the questionable area also. Okay. Who cannot file, or when updated return cannot be filed. Okay. If it results in decrease of income or increase of loss. If it results in decrease of tax or increase of refund. Okay, if it is going to result in, if it is assessee favorable, you cannot file. Only department favorable cases can be filed. Okay, if it is assessee favorable, you cannot file updated return. Okay. Violation under any other law. If you have made a violation under any other law, you cannot file updated return. Okay. If you are violated under, let us take smuggling law, prevention of smuggling law, okay, foreign exchange management law, like that, if you are violated in any other law, you have been, you cannot file updated return. If updated return is already filed. So here what we understood, updated return can be filed only once. Here we understood that updated return can be filed only once. Okay, if you have already filed an updated return, again you cannot file. That is why we interpreted updated return can be filed only once. Am I clear to you? Okay. Okay. Obligation of the assessee. Obligation of the assessee. Okay. Updated return can be filed after paying taxes. So don't file updated return saying taxes are payable. Pay the tax, then file the return. Okay, after paying taxes. Updated return can be filed only after paying taxes. Assessee is liable to pay additional income tax. That is, apart from the normal income tax, assessee is also liable to pay additional income tax. Okay, apart from the normal income tax, normal interest, normal fees, assessee is also, that's why the word additional, in addition to normal, 25% of tax plus interest, 25% of tax plus interest if updated return is filed within 12 months. 25% of tax plus interest if updated return is filed within 12 months. 50% of tax plus interest. 50% of tax plus interest if updated return is filed after 12 months but before 24 months. If updated return is filed after 12 months, but before 24 months. That is for the term, should I only offer income? Can I adjust the expenditure and offer the net income? You can adjust the expenditure and offer the net income. Am I clear to you? Okay, so this is one thing. Fundamentally, this can be a theory question or a small MCQ. Okay, not a practical question from here, 139.8, because updated return, when it comes to final, it's a more practical question of how much interest to work, how interest needs to be worked, and there are some penalty provisions available. Am I clear to you? Okay. Now, the next section is for the department. 139.9, defective return. (139.9) is about defective return. What is meant by defective return? That is, you have filed a return, you have identified some errors and omissions in the return, you file revised return. Department identifies some errors and omissions. You yourself have identified some errors and omissions. You have the option of filing a return, revise the return. Department identifies some errors and omissions, or some information is not there in the return filed by you. Department will send you a notice saying, boss, your return is defective. Boss, your return is defective. Please rectify it within 15 days. Otherwise, we will treat it as if you have not filed your return. Okay. The time limit might be extended if reasonable circumstances are shown, but generally this is the provision where department identifies errors and omission. Where the department identifies any errors or omission, they can file revise the return. Department identifies errors and omission. Okay. Sends notice to rectify the same. Sends notice to rectify the same within 15 days. Sends notice to the assessee to rectify the same within 15 days. Where assessee fails to rectify, okay, deemed that no return is filed. Deemed that no return is filed by the assessee, where the assessee fails to rectify, it will be deemed that no return is filed by the assessee. Are you all understanding? Okay, it will be considered as no return has been filed by the assessee, where assessee fails to rectify, it is deemed that no. Okay, however, some extensions will be offered by the department. Okay, okay.
So, for updated return also, the department only will identify, right?
No, assessee can identify.
Then what is the difference between the revised and the
revised return is only 3 months, or maximum October you are filing. Within 2 months you have to revise. And revised return is the mistake you have done. Updated return is because of the information that is available in the portal. Okay, there is something known as 26AS, etc., where we see some of the incomes which I am not even aware. Sometimes I might not be aware. The mutual fund agency or the bank would have filed with the department. So using that information, I file my updated return. Okay, revised return can be beneficial to you. That is, you have declared an income. Now you can, in your revised return, you can declare a loss which can be carried forward. But whereas in updated return, that is not possible. Shall we move on, friends? Okay. There is this section 139A, mandatory quoting of PAN. Okay, there is this section 139A, mandatory quoting of PAN. Let me take our material itself. Once we will just look into this section, because I find this being questioned also. Who has to file? Okay, who has to have a PAN? Okay, whoever files their income tax return, whosoever turnover exceeds 5 lakhs, okay, and any financial transactions, okay, deposits of 20 lakhs or more, opening of current account or credit card. All these people are to mandatorily require PAN, and the quoting of PAN is sale or purchase of motor vehicles other than two-wheelers, which means cars, lorries, buses will be required to. If you are opening a bank account, debit or credit card, demat account, hotel, 50,000 is the limit. Foreign travel, okay, stock exchange transaction, immovable property exceeding 10 lakhs, and they have clarified even if the stamp value exceeds 10 lakhs, even if the stamp value exceeds 10 lakhs, payment or deposit in cash in excess of 50,000 and transactions value in excess of 2 lakhs. All these people require PAN. And today, wherever you are, you have to quote PAN, you can even quote Aadhaar. That is acceptable. Interchangeability of PAN and Aadhaar is achieved. Let's answer the questions in page number 36. Mr. Kailash, ROR, could not file his return of income for the assessment year before due date prescribed under section 139(1). Advise Mr. Kailash as a tax. What are the consequences of non-filing of income within the due date under 139(1)? The following. Okay. Interest under section 234A, that is 1% for every month or part thereof, the assessee is liable to pay interest. In fees under 234F, fees under 234F, 5,000 rupees has to be paid. Okay. Carry forward of business capital and owning and maintenance of racehorse. Carry forward of business loss, capital gain loss, capital loss, owning and maintenance of racehorse are lost. You cannot carry forward the losses. Okay, department is empowered to levy penalty as well. They don't, but generally the power is there with the department. If you don't file your returns, they can levy penalty. Enumerate the cases where a return of loss has to be filed on or before the due date specified for carry forward of the loss. Also enumerate the case where losses can be carried forward even though the return of loss has not been filed on or before the question number 3. Mr. Nakash has undertaken certain transactions which are listed below. You are required to identify in respect of which coating pan is mandatory. Okay. Payment of life insurance premium, yes, coating pan is mandatory. Payment of 1,10,000 for acquiring bonds, not yet. Okay, it has not been notified. It has not been notified. Issue of credit card, yes. Payment of 1 lakh for foreign travel, yes. Sale of scooter, not mandatory because anything other than two-wheeler. Life insurance premium, yes. Remember, purchase of plot of land 9 lakh while the stamp duty is 11 lakhs, yes. Immovable property, they have made it that even if the stamp value exceeds 10 lakhs, not what the transaction value, if the stamp value exceeds 10 lakhs, coating is mandatory. In the following cases related to the previous year, the total income of the assessee or total income of any other person in respect of which he is assessable under the Income Tax Act does not exceed basic exemption limit. You are required to state with reason whether the assessee is still required to file the return of income. Manish and Sons sold a residential property where there was a capital gains. Yes, if you are claiming section 54 exemption, any of the 54 exemption, you have to. 1,20,000 consumption of electricity. Yes. If your per annum EB bill exceeds 1 lakh, you have to. Briefly mention the provisions of with regard to quoting of Aadhaar. Okay. Only for individuals, now there is an other. So other than individuals, this will not apply. And also for non-residents. No, fees will be what? 1,000. one more point. Even if your income does not exceed basic exemption limit, but you have to file your return, and filing it late, you have to pay 234F. Am I clear? Okay. Always before examination, a quick read through of this chapter. The 2-3 marks question will only come from this chapter. Just 2-3 marks. Max is 4 marks. Okay. A quick read through of this chapter before going to the examination for remembrance. Now let's go into assessment of individuals, where we will try to work out maximum today and tomorrow. If we have even completed this material today, I have something extra to work also tomorrow. We'll keep working till we go to the temple tomorrow. I'm in page number 22. Hema submits the following of our other assessment here: income from house property, business, LTCG, interest from FD with a bank, donation. PM drought relief fund in kind will not qualify. Any donation in kind will not qualify. PM NRF 100%. Approved university 100%. Drought relief fund paid by check 50%. Charitable institution limitation will be applicable. Okay. Political party 80 GGC, and medical insurance premium on own health up to 25,000 only allowed. Compute total income if she has opted for option given under, which means she is moving out of the new regime. Medical insurance policies are divided into two. Policy covering the health of assessee, spouse, and dependent children. Only dependent children, 25,000. Parents, another 25,000. There is an internal limit there. preventive health checkup. You can claim in total 5,000, but that can also be in cash. Others cannot be in cash. Okay. Any one of the person insured is a senior citizen. For that policy, it will become 50,000. If parents are senior citizen, 25 plus 50. If assessee is also a senior citizen, parent is a senior citizen, 50 plus 50, 1 lakh. Actual amount donated to charitable fund. Actual amount donated to charitable fund or charitable institutions, 16,000. 10% of adjusted total income. Okay. My gross total income is 162. 1,62,840 is my gross total income minus LTCG. Okay, LTCG is 21,840. LTCG plus 25,000 of 80D plus 10,000 of 80 GGC. This is my adjusted 10%. This is my adjusted total income of this 10%. Repeating, my dear friends, my gross total income minus whatever is taxable at a special rate minus all other deductions under this chapter except 80G and 80GG. Pakka clear? Okay. Okay, friends. Okay. Friends, one thing in examination we have to remember, because if at all they are, this should not be less than your special rate. For wild case, I am saying 162, 840. I get a deduction of 1,50,000. I cannot claim that because this 21,840 is 100% taxable. You cannot claim chapter 6A against income taxable at special rates. Okay. So even though the total comes to 1,50,000, the total of deduction, it will be restricted to some 140, whatever is the amount. Okay. You should be cautious in that. This cannot be lesser than your income taxable at special rate. Amit, aged 45 years, a resident Indian, has provided you the following information. He received a royalty of 2,88,000 from abroad from a book authored by him in the nature of artistic. The rate of royalty is 18% of the value of the books, and the expenditure made for earning this royalty is 40,000. The amount remitted to India till 30th September is 2,30,000. Okay. Provision of section 80 QQB, royalty income for authors. Okay. Assessee should be author or co-author of a book recognized by literary society, where royalty is earned from outside India. The same has to be brought into India within 6 months from the end of the previous year. Friends, out of 288, he only brought 2,30,000 to India. Remember, out of 2,88,000, he has only brought into India 2,30,000. To that proportion only, the exemption will also be, deduction will also be, because there is an expenditure of 40,000. Okay, there is an expenditure of, okay, 40,000. Proportionate royalty brought into India, 2,48,000 divided by 2,88,000 into 2,30,000. This is the income for this. What is the income for 2,30,000? what is the income for 2,30,000? Because there is an expenditure also which is incurred. Maximum limit 3 lakhs. Royalty cannot exceed 15% value of income தானே, வேல்யூ ஆஃப் புக்ஸ் கிடையாது ராஜா. இல்ல ராஜா, அது டோட்டல் இன்கம். அதுக்கு அவங்க டோட்டல் இன்கம் கொடுக்கணும். And there are various provision. As such, take it this don't worry about it. Okay, don't worry about this. May I? He owns an industrial undertaking established, okay, in a SEZ, and which he had commenced the operation in 21-22. So 21-22, 22-23, 23-24, third year. Total turnover, which includes 140 lakhs of export turnover of, oh, it's a full length question. Okay, I'm sorry. Then let me work out the full list. I thought case wise. Okay, then I'll do the full length question. He owns an industrial undertaking established in an SEZ which had commenced the operation during the financial year. Total turnover of the undertaking, which includes 140 lakhs of export turnover, which he has received in convertible foreign exchange profit. He was holding 20% shares, 30% shares in a private limited company, which means he is a substantial interest holder. The company allotted shares to shareholders. The paid up share capital of the company is 20 lakhs divided to 2 lakh shares of 10 each, which were issued at a premium of 10. He sold all these shares for 60, which are listed in a national stock exchange, and Mr. Amit had paid STT both at the time of acquisition and transfer. The fair market value is not at all important because shares were allotted after 31/1/18. Only for shares allotted before 31/1/18, FMV is important. Received savings bank deposit of 30,000, 80 TTA of 10,000. He occupies ground floor of his residential building and has let out first floor for residents use at an annual rent of 228. Municipal taxes 60,000. Both floors are of equal size. He paid insurance premium on life insurance of his son who is not dependent. You can claim. For LIC, for premium on life insurance, assessee, spouse and children. There is no word of dependent children, but remember you cannot claim for parents. Okay. And 48,000 on his dependent father. This you cannot claim under ATC. He paid 42,000 tuition fees for his 3 children. Only 2 children will be allowed. You are required to compute the total income and tax liability under normal provision. Okay, so I'll do the full question. Now read it once. Let's have that as a working note. Let's do the whole question. What are all the heads he has? He has uh, business or profession, house property, capital gains, IFOS. He has all the four heads. Okay, except salaries, he has all the four heads. Okay, and 80C is there, 80 TTA is there, 80 QQB is there. Okay, right? These are all the deductions he has. Let's go one by one. Let's first focus on house property. He occupies the ground floor and let out the first floor for residential use at an annual rent of 228. He has paid municipal taxes 60,000 for the current financial year. Less empty for let out portion will be 30,000. Equal size will be 30,000. Net annual value, standard deduction at 30%. So I'm getting a house property income of 138,600. Since interest is not there, profit from a business located in special economic zone. Profit from a business located in special economic zone is 20 lakhs. Less exemption under section 10AA, 20 lakhs into export turnover 140 divided by 200 into 100%. 20 lakhs into 140 by 200 into 100%. Full value of consideration. Full value of consideration. Company allotted shares on 1st October. The paid up share capital on that date 20 lakh divided into 10 each were issued at a premium of 30. Okay. He sold all these shares for 60 per share. How many shares? He is holding 30%. Company allotted shares to the shareholder. The paid up capital of the company is divided into 20, it is 20 lakhs divided into 2 lakh shares. He holds 30%. He holds 30%, which means 60,000 shares. Which means 60,000 shares. Okay. 60,000, that is 2 lakhs into 30%. 60,000 shares into, he sold all these shares for 16. Less cost of acquisition. $60,000 into 30. Gross LTCG taxable under section 112A. Okay, cost of acquisition. Okay, since shares are allotted after 31st Jan 2018, the FMV on that date is irrelevant. Sorry, it is 40, 10 plus 30. What happened? Shall we? ATC. Life insurance premium on Sun's Life. Life insurance premium on Sun's Life 39,000. Life insurance premium on Father's Life will not qualify. Please write it in exam also. School fees for 2 children of the employee of the assessee.
TCG shares indexation code.
You know, 112A, STT is paid at the time of purchase and sales. The question has said so, right? Of the Amit has paid STT both at the time of acquisition. That's why we are 112A, it is taxable. Is it clear, friends? Is it clear? Okay, okay, friends. Compute tax liability. Remember, whenever we are claiming 35 AD or 10 AA, work out adjusted total income also. Miss not that particular part. Shall I? Shall I? Are you catching up with this? Okay. Remember, LTCG taxable under section 1112A is LTCG taxable under section 1112A is 12 lakhs. Did I work out this wrongly? 14 lakhs, 14 lakhs. LTCG taxable is 12 lakhs. Income taxable at normal rate. Okay. Income taxable at normal rate. This minus 12 lakhs. I'm rounding it off. So minus 4. Similarly, this minus 12 lakhs minus 4. Okay. Tax on LTCG. First 1 lakh nil and the balance at 10%. tax, normal tax. Any doubts? Okay, please remember to work out 115 JC if there is 10 AA or 35 AD. For you, 80I will not come. Question number 3. Vijay Prasad, a non-resident aged 50 years, furnished the following information of the income in India for the year ended. Salaries computed. STCL, business income, business income wholesale, brought forward business losses, LTCG on sale of building, uh, lottery winnings, contribution to PF and NSC, income of minor daughter Manisha from a special talent. Compute his income tax liability, or assuming yes, after out of the default tax regime. STCL can be adjusted against LTC. Vice versa, not possible. Business income will first, you will set off the current year business loss, and whatever is the balance available, you will set off the, okay. Lottery, you have to tax it fully. Lottery, you have to tax it fully. My dear friends, okay, total income is less than basic exemption limit. Hence, no tax on normal income and no tax on LTCG, as deficit adjustment is possible. However, winnings are always taxable irrespective of level of income. Okay, winnings at the rate of 30%, less rebate under section 87A, as total income has not exceeded 5 lakhs. Actual tax, maximum rebate,
Sir,
Kanna?
the assessee is a non-resident, sir.
So
87A rebate is available, sir.
no, 87A is not okay. I didn't read the word non-resident. Sorry, only for residents. Only for residents. Thanks for correcting. He can claim 80C, but he can. Similarly, that 80 TTA cannot be claimed. Friends, we proceed to the next question, fourth question. Mr. Amit, having business of manufacturing of furniture, gives the following trading P&L account. Sales is more than 2 crores. So he cannot opt for presumptive computation unless that 5% condition is fulfilled. Okay. Closing stock, opening stock, purchases, freight, cartage, gross profit, income tax refund, warehousing charges. Whenever you see such words, please remember they might be going under 35 AD, because this storage of food grains, I mean storage of agricultural produce, sugar, all will qualify under 35 AD. Okay, whenever they were words warehousing charges, hotel, okay, residential apartment for house property, like that. On the debit side, bonus, rent, advertisement, bad debts, interest, depreciation, GST demand paid, salary, miscellaneous expenses, net profit. Income tax refund includes interest. Salary include 30,000 paid to his brother, which is unreasonable to the extent of 5,000. Advertisement include 2,500 paid for the souvenir of a political party. Miscellaneous expenses include 1 lakh paid to political party by check. Goods and service tax demand paid includes 5,300 as penalty, which is not allowed, and 12,750 interest allowed. Mr. Amit had purchased a warehouse building in the rural area for the purpose of storage of agricultural produce. This was made available from 15/7 and the income is credited to warehousing. Depreciation under Income Tax Act worked to 65,000 other than depreciation on warehouse. Interest on loan includes an amount of 80,000 paid to Mr. Mohit, a resident, on which tax was not deducted at source. Compute total income and tax liability in the most beneficial manner. We need to work out normal AMT and also 115 BAC, where you cannot claim that again specified business deduction. Okay, patiently read through. First, I'm working out taxable business income. Of course, there is only one other source, that is interest on, but this is taxable business income. I'm doing the general business part of it. Opening stock, purchases, freight, bonus, rent, advertisement. The first adjustment, one of the salaries, there is an adjustment. Salary later only comes. Okay. First advertisement include 2,500. Okay. Advertisement in the publication of political party disallowed $2,500. Advertisement, bad debts allowed, interest on loan 251,750. The last information says interest on loan includes an amount of 80,000 paid to a resident without deducting tax at source. 30% of interest paid to a resident without deducting tax at source. 40. So 80,000 depreciation as per books 1,07,250. GST penalty paid, GST penalty paid 5,300. Here itself I'll write. Okay, only penalty is disallowed, whereas interest is allowed. salary paid to a relative in excess of fair market value. Salary paid to a relative in excess of fair market value, 40A subsection 2. The excess amount is disallowed. Miscellaneous expenses include miscellaneous donation to a political party, not a business expenditure. However, 80 GGC can be claimed. Less Aja, items credited but not related to this business. Income tax refund 30,000. Warehousing charges treated separately. Less allowable depreciation. Is it clear? Is it clear, my dear friends? Shall I? Okay. Business or profession, general business, specified business under section 35 AD, storage of agricultural produce. Income 22,50,000 less cost of building all capital expenditures other than land, goodwill, and financial instruments can also be claimed as deduction. How much?
20.
20 lakhs. Am I clear? Shall we, friends? Shall we? Okay. So this is the total income under the normal provision. Now I am going to go for three-cornered working, that is normal provision, ATI, that is AMT, and also if I have opted for optional tax, that is concessional tax regime. How does this work? In both the cases, 35 AD cannot be claimed, depreciation can be claimed. Under concessional tax regime, I cannot claim 80 GGC also. Under concessional tax regime, I cannot claim 80 GGC also. So first I will go for AMT working. Okay, always be careful about the date. Suppose if they have given 15, 10 and all, you should do 5% only. Okay, before providing the depreciation, go and see whether the date of putting it into use is given. Obviously, concessional tax regime is out of question because you're getting a surcharge directly. Pays tax under normal, because everything, there is no special rates of taxation, everything is normal rate of taxation only. Okay, 31, 36, 120 minus 10 lakhs. So 21, 36, 120 into 30% plus 112, 500. Under concessional, 50 minus 15 lakhs, check out the amounts once. May I? You're clear on this? Okay. Okay. A question to understand all the three methods. Mr. Vishal, aged 33 years, submits you the following transactions during the financial year. Vishal has a house in Delhi. He has transferred the said house to Deepika, daughter of his brother, without any consideration. House would go back to Mr. Vishal after the lifetime of Deepika. The transfer was made with a condition that 10% of the rental income from her house should be paid to Mr. Vishal, rent received from the house property. Mr. Vishal holds preference shares in a private limited company. He instructs company to pay dividend to his daughter, to daughter of his servant. The transfer is irrevocable for the lifetime of Chandani. Dividend received. Mr. Vishal has a short-term capital loss from a sale of property and long-term capital gain from the sale of property. Other income or losses of Vishal includes interest from savings bank account. cash gift of 75,000 received from daughter of his sister on his birthday. Taxable. Brothers and sisters are only relative, their spouses. Daughter of sister, taxable. Income from betting of 25,000. Income from card games, 46,000. Loss from racehorse. Compute the total income if he has opted out of the default tax regime and the losses to be carried forward. Ring through. For the first, I'll write the note. Okay. Concept of revocable transfer under section 61, where the transferor retains right over the asset or right over the income of the asset, either partially or wholly. It is considered as revocable transfer. Are you understanding? Okay, where the transferor retains right over the asset. Anytime I can get back the asset. Retains right over the income generated by the asset. Okay, then it is known as revocable transfer. Income from such a revocable transfer is taxable only in the hands of transfer. So, whole of the income. However, one of the exception provided is that where revocation cannot be made during the lifetime of beneficiary. Where it cannot be revoked during the lifetime, only after death you can come, the property will come back to you. Okay. Now if I read it, Vishal had a house which he has transferred to Deepika, daughter of his brother, without any house will go back to Vishal after the lifetime of Deepika. After the lifetime of Deepika. In this case, Vishal cannot revoke during the lifetime. You're understanding, friends? You're understanding? This case clubbing provision will not apply. Next case is concept of section 60. Transfer of income without transferring asset. Where assessee transfers income without transferring source of earning such income, then such earned income will only be clear, friends? Check the head. One is IFOS dividend. Vishal has STCL 16,000 from sale of property and LTCG 15,000. Other income or losses of Vishal includes savings bank interest, cash gift, winnings, loss from maintenance of racehorse. Okay. So first it is capital gains. LTCG from sale of property. $16,000. In this question, I forgot to write the note that since Manisha has earned it due to special talent, it is not clubbed. Okay, suddenly I got reminded. This question, I should have written the note that since the assessee has a minor daughter, okay, otherwise I would have clubbed it. Otherwise, I would have clubbed it. Please remember that point, okay. Less STCL on sale of property. LTCG is 15,000. 16,000.
So your screen is blurred, sir.
Now, now refresh and see, friend. Now refresh and see. This cannot be set off against any other income, so this needs to be carried forward.
Sir, it's still the same, sir.
Dividend earned by Chandini. So I'll speak so that you can also listen. Dividend earned by Chandani because it is taxable now. And savings bank interest in the outer column. Okay, 1,75,000. Gift received from sister's daughter. Okay. Only sister is a specified relative and not daughter of sister. Only sister is a specified relative, not daughter of sister, and the value of gift exceeds 50,000. So the entire 75,000 becomes taxable. The entire 75,000 becomes taxable. Winnings, okay, both betting and card games, both are winnings. 25,000 plus 46,000. Both are taxable as winnings because both enjoy the same special rate of 30%. Both are winnings. And loss from maintenance of racehorse to be carried forward as it can be set off only against income of same head. So I need to carry forward that 14,600. Now I will get my gross total income. Now I will get my gross total income, which amounts to me for 7,71,000. 7,71,000 gross total income. Okay. Assessee's age, Vishal, age at 33 years. So 80 TTA only is applicable. 80 TTA is only applicable. Deduction under section 80 TTA as assessee follows normal tax regime 10,000. The actual interest is 175, so 10,000. Total income 7,61,000. They have not asked for the tax, so we are not working. Could that be recollected revocable transfers also? Question number 6. Mr. Sunil, aged 48 years, a resident Indian, has furnished the following particulars during the year. He occupies ground floor of his residential building and let out the first floor. Annual rent, municipal taxes of 25,000, both are regarded. As per the interest certificate, 150 as interest, 80 is towards principal and repayment of housing loan and the above building. So that qualifies for 80C. Okay, almost the same question with different numbers, but some more information. He owns an SEZ which had commenced in the year 1920. 1920, 2021, 21-22, 22-23, 23-24. We are the 5th year. Total turnover, which includes 150 export turnover. Out of 150, 120 is only brought into in the Indian currency. I mean, The Indian industry undertaking fulfills all the conditions of 10AA and 40 lakhs is the profit. He employed 20 new 80 JJAA. He employed 20 new employees for the said industrial undertaking. Out of 20, 12 are employed from 1st May for a monthly emoluments of 18 and remaining from 1st September for a monthly emolument of 12. All these participate in RPF and they are paid directly in their bank account. He earned 30 and 40 as interest on savings and fixed deposit. He has also sold his vacant land for 15 lakhs. The stamp duty on the date of transfer. The land was acquired before 1/4/2001. The fair market value as on 1/4/2001 and the stamp duty. Incurred registration expenses 12,000 at that time. The cost of indexation values. He paid insurance premium towards life insurance of his son who is not determined. Compute the total income and the tax liability in the manner so that he can make maximum savings. Read through. So obviously tax liability is there. Obviously we have to work out ATI, AMTs. Please read through. Let's do some working notes and then come to the main answer. Okay, house property and capital gains. Let's do the working note and then come to the main answer. For self, every, the law says every unit will be treated as a separate house property, which means unit 1, which is self-occupied, can have 2 lakhs. Unit 2, let out, can have 1. If the total interest is 450, you claim 225 for let out, 2 lakhs for self. I'm doing the capital gains now. I'll do PGBP also, because lot of writings needs to be made. So let's do everything as a working note, go there and do the main answer. Total profit of the unit located in special economic zone, 40 lakhs, less exemption under section 10AA, less exemption under section 10AA, 40 lakhs into 120, money brought into India in convertible foreign exchange within 6 months from the end of the year, divided by total turnover is 400. So out of which includes 150, only 120 is brought up. Sale of immovable property, full value of consideration by applying the provisions of section 50C. Actual consideration Is it still blurred, my dear friends, online?
Yes, sir.
Sorry, friend. I'll after the break, I'll definitely rectify it. As of now, I will keep telling the answer.
Sir, it's actually comparatively better now, sir.
Okay. Actual consideration 15 lakhs. 110 percentage of actual consideration, that is 15 lakhs into 110%, or stamp value, which is the question saying 16 lakhs. Okay, so by applying the provision, since Stamp value has not exceeded 110% of actual consideration. The actual consideration will be treated as full value of consideration. So 16 lakhs will be treated as full value of consideration. 16 lakhs will be treated as full value of consideration. There is no expense. Please remember, he incurred 12,000 at that time. This is at the time of purchase, not now. This is at the time of purchase, not now. Okay, so that doesn't matter also, because the actual, okay, less indexed cost of acquisition. Okay, I will take the stamp value 4 lakhs, stamp value as it is lesser than fair market value, into 348 divided by 100.
Sir, actual consideration is 15 lakhs, no, sir?
Thanks for correcting. Gross LTCG taxable under 112. This is taxable at the rate of 20%. This is taxable at the rate of 20%. Going to the main answer. Information over, second information over, third information over, fourth I have to do, fifth. 80C, principal portion of housing loan. Principal portion of housing loan, okay, which comes to 80,000, which comes to 80,000. JJAA for new employees. 80 JJAA for new employees. 80 JJAA for new employees. Friends, conditions are the gross remuneration should not exceed 25,000. Employee should have been covered under PF. Worked for minimum 240 days. That is, should be employed before 1st of August. In this case, yes, covered under PF, yes, 20 out of 12 are employed on 1st May. They will be eligible. Whereas whoever is employed on 1st September will only be eligible in the next year, not in the current year. Not in the current year. Are you understanding? Okay. 12 employees into 18,000 into 11 months, May to March, into 30%. 12 employees, okay, all conditions are fulfilled. இருக்கா? நான் யோசிச்சேன் லாஸ்டா, அதான் எங்கேயோ படிச்சேனே, வேற ஏதோ இருக்கு. He paid insurance premium for his sons. This clear? Is this clear? Adjusted total income under 115 JC will be total income under normal tax system plus exemption claimed under 10AA plus exemption claimed under 10AA. Okay, total system under normal plus exemption claimed under 10AA is 12 lakhs. But my main focus is to make you also be clear about the new concessional tax regime. Okay. Under concessional tax regime, total income under normal tax regime, total income under normal tax regime, add, my dear friends, self-occupied house property interest that cannot be claimed, self-occupied house property interest of some 75,000 cannot be claimed, 75,000. 10AA exemption of that 12 lakhs cannot be claimed. 10AA exemption of 12 lakhs cannot be claimed. Okay. 80C cannot be claimed. 80C cannot be claimed. Okay. 80TTA cannot be claimed. Please remember, they can claim 80JJAA. They okay, under concessional tax regime, we can claim 80JJAA. How is the screen now, online friends?
So, okay, sir.
Priyanka is the general manager of a company, furnishes the following information: salary, value of medical facility in a hospital maintained by the company. Okay, it is not taxable. Perquisite, where the treatment is undergone in an hospital owned by the employer, it is not a perquisite. RFA owned by the company, housing loan at an interest of 6%, no repayment made. The rate charged by SBI 9.5%. A dining table was provided at a residence. This was purchased on 1/6/20 and sold to Priyanka for 30,000. Personal purchases through credit card provided by the company amounting to 10,000 was paid by the company. No part of the amount was recovered from Priyanka. A Maruti Suzuki car which was purchased for 250 was sold. Other income received includes interest, income from specified mutual fund, interest on FD of a minor married daughter. Minor will not be clubbed. Okay. deposit in PPF account 40,000. Compute the GTI if she has exercised the option to shift out of the default tax regime under 115 BAC. Read through. Okay. In an RFA question, I want you to be aware of two things. Number one, as soon as the question starts, you check the whole question whether any other allowances are given later. Okay. Before RFA alone, we have to be really careful. Suppose as the seventh adjustment, they might have given an allowance. Seventh item, they might have given an allowance. So we should read it one. And as I told you, till 31st August, 15%. After 1st September, 10%. So there is no specific working note I look for. I understand car has a working note, but we will do it as a part of main question. So we'll start with the main question. Start. Perquisite value of medical facility provided in a hospital owned by employer, nil. Perquisite value of rent-free accommodation. $40,000 into April, May, June, July, August. 5 months into 15%.
Sir, in case RFA is hired by the company, then is it 15 and 10, sir?
Once more.
If the RFA is hired by the company, hired.
If the company takes it on rent, that's what you're asking.
Yes, sir.
Yeah, 15% or actual rent paid, whichever is less. 10% or actual rent paid, whichever is less. Same 15 and 10.
Okay, sir.
For a dining table, this was purchased on okay, for April, it is used by employee, then only transferred on May. So first I am doing for usage 60,000 into 10% into 1 by 12. Remember, there is a usage also. Okay. Car, they have not said usage. It is directly given as transfer. Whereas as far as a dining table was provided at a residence, so there is a usage. Purchase price on 1st June 20. Depreciation at the rate of 10% for 21, 22, 2 years only. Third year is not completed. On 1st May itself, I transferred for 2 years only on SLM basis. No more depreciation. No, no, it's not. It's IFOs.
Then why did they do that with the company?
So what? If I have some surplus fund, I invest in the same company, debentures or bonds, whatever it is.
With the company means where we are working.
Whether we are wherever we are working or not, it is IFOs. It is, you are not getting it in the capacity of an employee. Clear? Ravi and Sons, a partnership firm, consisted of two partners, reports a net profit of 750 before deducting the following. Salary 25,000 per month, each payable to two working partners. Depreciation on plant and machinery. Interest on capital 15% authorized by the deed. The capital eligible interest is 6 lakhs. Carry forward loss 50,000. Compute for assessment year the book profit and the salary that can be paid to the working partner, because we don't have assessment of firm, but salary computation we have. Book profit means profit as per PGBP chapter after providing for interest on capital but before remuneration. For both partners, it's not each. Loss you need not adjust. There is no adjustment for loss. Losses as per set of chapter only. We are computing as per PGBP chapter only. Okay, so you need not adjust a loss, my dear friends. For remuneration, book profit for remuneration. Book profit for remuneration. Maximum permissible remuneration under section 40B, my dear friend. As per deed, the actual salary comes to 25,000 into 12. Or each other, so each. So 25,000 into 2 into 12. 25,000 into 2 into 12. Okay. As per law, 2 lakh on the first 3 lakhs, 2,70,000. And on the balance 1,28,000 into 60%. So the question asks, what is book profit? What is remuneration? So these are all the main answers. Mr. Ayush, a resident individual, is engaged in the business of manufacture of textiles, earned 82 lakh 45,000 profit after debiting or crediting the following: depreciation, STCG on listed shares, income tax refund, dividend income from Indian companies. Dividend received from each company is less than 5,000, which they are saying this because tax will not be deducted at source. Okay. Additional information. Ayush installed new plant and machinery which was put to use on 1/1/24. Depreciation, including additional depreciation on this, on this 65 is included in the depreciation debited to P&L, which has been computed as per IT law. Mr. Ayush took a loan from SBI to purchase such plant and machinery. The total interest up to 31/3/24 had been paid on 31/3/24, and the same is debited to P&L. Advance tax during the year. Ayush purchased goods for 40 lakhs from Mr. Ram, his brother. The FMV is only 35 lakhs. He paid 40 lakhs as life insurance premium on the life of his married daughter, no problem. Sum assured is 5 lakhs, so less than 10% only. He paid 45,000 for health insurance, 25,000. I hope he is not a senior citizen. 54 years, so 25,000. 25,000. He on 1/7, Mr. Ayush withdraw 1.5 crores in cash from 3 current accounts maintained by him. There were no other withdrawal during the year. He has been regularly filing his return. You are required to compute the tax total income and tax payable, which means they want us to reduce the advance tax and the TDS. For this cash withdrawal, there will be TDS. For this cash withdrawal, 194 yen up to 1 crore, no, nothing. More than 1 crore, 2% they would have withdrawn, they would have done, assuming he has shifted out of the default tax regime. Okay. So, and interestingly, the depreciation 15 lakh 40,000. Ayush installed new plant and machinery, which was put to use on 1/1/24. Depreciation, including additional depreciation on the 65 lakhs, is included in the depreciation debited in the P&L account. So there is nothing to disallow and again compute, but something very, very interesting. Ayush took a loan from SBI on 1/9/23 at 10.5% per annum. Okay, at 10.5% per annum to purchase such plant and machinery. But whereas the machinery was put to use only on 1/1/24. So what happens is, our law, we have studied, interest up to the date of putting the asset into use should be capitalized. So September, October, November, December, this 4 months interest should they should not have debited to P&L. They should have capitalized. On that they can claim both normal and additional. He has opted out of the normal. Okay, they can claim both normal and additional, which is what we are going to do. Okay, advance tax, Ayush purchased. Okay, right. Okay. Right. First, we will compute his business income. interest till the date of putting the asset into use should be capitalized. In the given case, loan was taken on 1st September for an asset which is put to use on 1st Jan. So, for 4 months, the interest needs to be added to cost of asset. Assessee has debited, it should be disallowed. Patiently, right? I'll wait. 50 lakhs into 10.5% into 4/12. Okay, friends, this is additional information. So don't assume advance tax has been debited. It is not so. It is not debited. Okay. Depreciation that needs to be provided for the interest that is capitalized with the cost of the asset. Okay, on this 1,75,000 I need. Okay, for others, depreciation is correctly provided. For this alone needs to be provided. Asset is put to use for less than 180 days. We should remember that it is 1-1. Okay, normal depreciation at 7.5% of 1.75 lakhs. Check it out, check whether I have missed anything, any information also. I'll do the total income first. First. Interest on refund is an IFOS item. I'll come to that. First, I have only done business income. That's what you say, no? That I'll come to IFOS. First, I have taken it out. The full refund amount has been credited. The interest part has to be